Yo, what's up for everyone on the YouTube replay? Hope you're having a great day. Don't go anywhere because I'm going to be going over the new dividend stock I just bought. I'm going to do a quick portfolio update, and then you'll see in my Webull portfolio a new dividend stock that has a 3.3% dividend, and it keeps up, if not does better than the S&P 500. It's a great stock in my opinion, I think, and I just bought the dip on them. So let me show you my stock portfolio update. This is my Moomoo account known as my buy, never sell portfolio. We are down 0.26% on the day, but that's no big deal because year to date we are doing very nicely. It looks like Amazon's green. Powell Industries is nicely green on the day. Let's go. I know there was some article that came out about Powell Industries today, how they're a super sell or something. I don't know. And here is my Robinhood portfolio. This is known as my dividend only account. And every stock in here pays a dividend. They're all also in the S&P 500. A bit of a mixed bag day. Looks like Google's going green on the day. And Google actually announced a dividend. Oh, and Progressive Corp announced a $13 special dividend. I'll show you that in a second here. But yeah, these are all the stocks that I own in here. Here's my total percent change on every stock. So luckily, we are green on every stock except for Carlyle Group right there. And we also have a Roth IRA. Look at that new intraday high right now. We're up 1.99% on the day. I think that's mainly from Cormedics. Dude, this stock was up like 6% yesterday. Look at this. They're up 21% just on the week. So not too shabby. This is one I've kind of been talking about. And I always, every time I cover them, I always want to say you never want to own this with like some meaningful amount of money because there's just so much risk there. But I love their numbers. So yeah, that's our Roth IRA. Roth IRA is just a tax-free retirement account. This is hey, what up? This is not a rerun or whatever. Do I own SEHG? No, man. But check this out. Here's what I want to show you. This is the new stock I just bought in my Webull portfolio. This is kind of like our risk on account. I kind of just do whatever I want in here. I'll buy stocks, sell stocks. We're only up 21% all time. So not exactly some amazing performance, but check this out. The new stock we just bought today for the first time ever is ticker symbol SO, Southern Company. This is a utility company and they have a 3.5% dividend yield. Now, this is a regulated utility and no matter what, these utilities just always return like 5 to 10% a year. Somewhere in between is a nice middle ground. But with all this new AI demand, this is ticker symbol VPU, just the Vanguard Utilities ETF, and its market cap weighted in its second largest holding, or actually third largest holding, and now a Southern Company. Constellation Energy took over as the second largest position. Yo, I'm even more bullish on Constellation Energy than Southern Company, because Southern Company does have a pretty high dividend payout ratio. But let me show you what I love about this company. They own Georgia Power and Light, Alabama Power and Light. Like, they own so many great utility businesses. But check this out right here. In the most recent quarter, they made $1.7 billion in net income. If we kind of average it out here, they did have a little one-time adjustment right here. But let's just call it like just over 1.3 bill of net income a quarter. Oh, and the free cash flow is even better. But check this out. They're making like 1.3 bill of net income a quarter. Let's go see. And the dividend right here, the dividend cost 760 million of net income every quarter. And they don't even dilute you. I mean, 0.5% year over year. So no dilution here, which is cool. So yeah, I think it's just going to be it's just a nice addition to a dividend growth portfolio, I think. Nice 3.5% dividend yield. It's a utility. I think it should keep up with the S&P 500 and the whole utility index. So yeah, it looks like a safe dividend company. And check this out. Another great news there. What up, Looney? Where did you find Progressive Corp special dividend? Check this out. If we go to Progressive Corp right here, they actually announced a $13 special dividend. I just clicked on the news tab right here and I saw right here, Progressive declares $13.50 per share annual special dividend. Actually, they did a $13.10 special dividend. Because their normal dividend is only 10 cents a quarter. So anyway, yeah, that's actually, well, we have 4 shares, or wait, how many shares do we have? I lost it. Oh yeah, we got 4 shares. So that should give us like $40, just over, close to $50 actually, not too shabby. So that's what's cool. You know, they actually do an annual special dividend to reward the shareholder every year, kind of like Futu. I'm actually very curious to see if Futu will announce a special dividend soon. I actually have been buying the dip on this company. Check this out. Here are my 2 buy orders recently. This is a brokerage, kind of like it's like a cheaper Robinhood, but they have, like, in my opinion, way higher growth potential than Robinhood stock. But I'm also a Robinhood shareholder. I own a lot of fintechs: Robinhood, Futu, SoFi, Dave. And yeah, I actually did trim. Here's what I trimmed to buy Southern Company today. I made this my holding down here. I trimmed UiPath. So I only have, I have exactly 100 shares of UiPath right here. I've been trimming them a little bit. So Yeah, and I sold some, 2 shares of Disney, so that's interesting. But yeah, if you guys got any stocks you want me to look at, let me know. That's what I bought as my most recent position in there. Let me know what you think. Someone said, "Why don't you have any ETFs?" Hey, I am like my own ETF. But yo, I always recommend for everyone, yeah, just buy the S&P 500 because most individual investors can't beat the S&P 500. So you need to have the S&P 500 as the backbone of your portfolio, or at least own a lot of the S&P 500. And like most of my companies are in the S&P 500. If I actually go over here, every single stock in here is in the S&P 500. HCA is. And I got Amazon. Oh, Comfort Systems is now in the S&P 500. Literally 2 days ago, it was announced that this company's in the S&P. So yeah, we have Amphenol, Amazon. I wonder if Ferrari is actually. Yo, I forgot. I actually bought, and I never mind doing this. Fractional share buying. So I actually bought, and there it goes dipping more. But I actually bought zero point 0.1 shares of Ferrari today because I had a little bit of cash left over from a dividend. So I spent my extra cash. I only got $2 left, but on buying zero point 0.1 shares of Ferrari. So I'm never opposed to buying like a fractional share of a company. If you ever start your own ETF, what would it theme be? I'd probably call it something like the Never Sell Diamond Hand ETF, and it'd be this Moomoo portfolio or something. Snowflake. Hey, yeah. So this company just reported earnings. This is like a smaller Palantir. They're still huge though. $76 billion company. I really think they're going to be a huge AI beneficiary because it gives companies actual usage with their data. And the only thing that sucks about Snowflake and why I can't buy them, I'll show you that in a second. Here's the good news. Let me go over the good news first. Is the growth here. Like, this is why they deserve some attention because check out their top line growth. I mean, the sales are 1.1 billion this quarter, up 28% year over year. After grew 29%, after grew 37, after grew 84, after it, this is incredible growth. But the only thing I don't love are these net income losses. They're losing 300 to 400 million of net income a quarter, which is unfortunate. But here's the good news. Analysts expect them to lose this net income every quarter, and they've actually been losing less net income than expected the past 2 quarters. But despite that, they actually um, have like gapped down on earnings. I do wonder why. Last quarter was great. They gapped up on earnings, but this quarter, I don't know what exactly caused them to gap down so much. Because it was a triple beat at first glance in the analyst expectations, a triple beat quarter, announced new partnerships. So maybe it's just getting back to reality. Let's see. Customer base expanded by 615 new clients, including 766 Forbes Global 2000 firms. Pretty cool. AI related revenue hit a 100 million annual run rate ahead of schedule with over 7,300 accounts using their AI. So yeah, pretty cool. Nice AI beneficiary. I just don't love the net income losses right now. Hey, bro, Nvidia's going to start selling. Yeah, they can ship their H20 chips to China. Hey, what up, Spread the Wealth? FOMC this Wednesday should hopefully bring volatility back to the market. Exactly right. So check this out. We head over here to the market literally on December 10th, which is Wednesday, which is tomorrow, right? Yeah, tomorrow we get the FOMC meeting, and there's a 89% chance of a 25 basis point cut. So it's pretty much guaranteed we're going to get a 25 BP cut, 10% chance of no cuts. So yeah, maybe don't really do anything today. We're really, I guess, just waiting for what happens tomorrow. Maybe numbers got leaked. Did y'all see Bitcoin today? Maybe the numbers got leaked. Let's check out Bitcoin right here. Up a nice, almost back to 95K. Nice little gap up candle there. So yeah, that's helping out Webull too. Not too shabby. So yeah, hey, the new stock real quick. Someone just asked. The new stock I did buy is Esso's stock right here. This utility company, 3.5% dividend, but also appears some nice stock price appreciation that doesn't lack either. All right, so what do you think about Vici? Hey, this is another kind of dividend play. I am a little worried about Vegas right now because what Vici property does, and let me see if I can get this one to load. This is a REIT right here, a real estate investment trust. Sorry, there we go. My Wi-Fi is a little slow today, so as it always is apparently. So, dang. Let me see if I can get this pulled up here. But yeah, Vici is on a nasty little downtrend right now. That's not good. Can't go wrong with Nvidia. Yeah, Nvidia is doing great right now. Okay, this is not good. I'm trying to get this. There we go. Okay, it disconnected. We're back. That's why it wasn't working. Sorry. But here's Vici Properties right here. This is a REIT. They own a bunch of triple net leases in the Vegas properties, and their main customers are literally these people right here: MGM Resorts, Caesars, and those are all stocks right here. Win. Here are, yeah, so gaming properties, 54 gaming properties, and they're all in Vegas. So they own the triple net leases for Caesars Palace. I was just there uh, in April. Well, not just there, but MGM, all these different properties. The Luxor. They also own the land, the triple net lease under the Las Vegas Sphere. So they own a bunch of REITs, or I mean, a bunch of property, the leases in Vegas. And if I look at all their top tenants right here, CZR, for example, I would not own any of their top tenant stocks individually. Like Caesars is one of their top tenants. Would I buy them individually? No, they're the same price as they were in 2017, unfortunately. MGM, aren't they publicly traded? MGM Resorts, check this out. Oh no, their stock is dang the same price as it was in 2005. Let's not forget Wynn Resorts here. These are all their tenants, their gaming property kind of people. It looks like this industry just isn't doing great, and not one you really want to own in the long run. But the best position out of all these stocks, the best one to benefit is Vici Properties, though, as they should collect that tenant, that rent, that every single month. But yeah, they have a great yield. They're a REIT, so they have to pay out most of their dividend or most of their money in the form of a dividend by law. Okay, there's another YouTube that does stocks, only does dividend stocks, by the Dividend Kings. Hey, I'm not sure what um who that is. I wish I could comment on that. But yeah, Dividend Kings are cool. Those are companies that have been raising their dividends for over 50 years and never had to cut it once. Like Johnson & Johnson's one of the best examples of that. McDonald's, they even in 2008, even during 2020, they rose their dividends that year. They've never had to cut it once. They're just so safe. I'm in an IBIT Friday call. Hopefully it goes up. I'm up 67% right now. Dang, yeah, owning a call before today did you well on Bitcoin, I will say. And yo, FOMC meeting, it will bring a lot of volatility to that as well. Hey, what up? Good time. Good to see you all. Thoughts on, oh yeah, that's another one. That's Realty Income. That this one hasn't done too well either. You're kind of buying this to maximize your income because the dividend is super safe. But notice it's like this is 2020, but they're way below their pandemic 2019 price. But they have a super sustainable monthly dividend. You get a 5.6% dividend that pays monthly, and it is sustainable. But you're not going to keep up with the S&P 500 in the long run with this. There's like a hidden opportunity cost where you basically just get the dividend every year, and you get no stock price appreciation. So you might underperform the market by, half by owning that. And the dividends you receive are non-qualified. So you want to own that in a Roth IRA because you pay the higher taxes. So you buy that when you need the income. But it's a super sustainable dividend. If I was looking for a monthly pair that's sustainable, I would check them out if I just wanted a dividend. That's like a better way. That's like a better than like a money market fund or something. Like a Realty Income is better alternative to a money market. But let's check out PayPal right here. PayPal, I'm kind of being so bearish on these stocks. My bad here. I just try and keep it real. But here's PayPal right here. Sadly, PayPal is the same price that it was in 2017. And they just announced their first ever dividend. What was the dividend payout? The dividend was 14 cents. How much EPS did they make a quarter? EPS was $1.30. So that's around just over a 10% dividend payout ratio. So that's actually a low payout ratio for, they have around over a 1% yield. Let me look at the annualized yield real quick because the annualized yield on PayPal, or it's basically dividend yield, is a 0.9. Okay, so you get a 1% dividend or 0.9% dividend for a just over 10% payout ratio. They're trading at a 12 PE. This is really a multiple where it's like PayPal's priced where it's not really expected to create or lose you any value, like a commodity multiple almost, which is unfortunate. Here's what I do like that PayPal's doing. The annual revenue growth has slowed down, but mid single digits. Last 2 quarters it was bad. 1%, 4, 5, but it got better this quarter. But look at the net income. This is the good news. They're easily making 1 to 1.3 billion of after tax net income a quarter. After they pay 300 mil of taxes a quarter. And what are they doing with that billions of net income? Because They don't pay a dividend. Well, they now pay a dividend, which is only like 120 mil, I'm guessing. But they do massive share buybacks. They're doing 1.5 bill of buybacks a quarter. And here's what those share buybacks do for you as a shareholder. If we look at the net income, it grew by 23% year over year, but the net income per share grew by 31%. Again, the EPS growth rate and the net income growth rate should always literally be the exact same. The only thing that changes this is the share part of the ratio, and there's less shares that exist, which makes the EPS go higher, which makes the PE ratio go lower, makes the dividend cost go down, gives you more ownership in the company. So in short, it just forces the stock to go up, but it's a good time to buy back their own stock. I almost wish they were doing acquisitions with that money. Like they own Venmo, PayPal, those could, or Venmo and Honey. I mean, those could be some nice growth drivers. They need to monetize Venmo, as they haven't done that yet, which is good. I know XYZ just got added into the S&P 500, which is Cash App. They are also Cash App and PayPal. Look at this. Dang, it's not just PayPal. Look at Cash App stock. They're the same price as they were back in 2018 as well. So it's kind of not just PayPal specific. Looks like maybe crypto might be coming for them. Who knows? But hopefully that was helpful there. Hey, Wodeo said, first time here. I'm glad I found your channel. Hey, thanks so much, man. I really appreciate that. Yo, if you guys wanted the follow button, we actually stream every day. I literally sell nothing. I have no course, book, WhatsApp. Please watch out for people impersonating me. I'll never follow you. Sell nothing at all. The only way to support me is just subscribe to the YouTube channel, watch the videos and stuff. Hey, what up, Jim? He said Johnson & Johnson. This is like the most blue chip of all blue chips, but they're up like 50% or 40% year to date. And it's really because of their oncology business and their Shockwave acquisition, which is now so accretive to the business. And it's really their oncology division that's driving so much growth right here. They print money. I mean, the net income is crazy. They're making like easily. Well, they had back here, they were in some lawsuits because, I forget it exactly, but they tried to spin it off, but they weren't allowed to. They were in some lawsuit payouts about something, but now that that's kind of out of the way, the stock can really revive again. So it's just a safe company with the 2.5% dividend. They do some share buybacks as well. Just a safe blue chip that has done surprisingly well. Net income's up 90. Okay, so they haven't done any share buybacks this past year, but interesting. Johnson & Johnson is pretty nice. Oh yeah, this app, if it's in the link, if you want to get this app I'm on right here, it's in the link tree in my bio, that very first link there. So let's see. Can I join the Discord? Yo, actually, if you become, I never like to say this. If you become a member, you also get access to it, but I don't like to say that. Yeah, if you don't have PayPal and wanted to still join the Discord on TikTok or actually on YouTube. I can. All right, let's see here. Apple stock. What up, Blake? Let's do Apple right here. A great never sell company right here. Netflix. Hey, cheese. Remember, I want to look at Netflix after this. I do definitely want to get to that one. Hey, Katrina. Good to see you. CorMedix is exploding today. Yeah. So here's Apple right here. They've really been, the market has rewarded them for not spending so much on AI. Like Apple's always historically late. Like they were late to the phone and the smartphone, but they made the best one ever. And now they do great. And so if we go to their cash from investing activities, they're not like Amazon, Google, Meta. They're all spending like 10 to 30 billion of their like freaking 10 to 30 billion of net income a quarter on AI right now, on chips and data centers, and Apple isn't spending a dime. Apple pays Google $1 billion a year to integrate Gemini with Siri because they don't want to spend so much. It's a smart thing right now. So let's talk about their actual business, though. They sell iPhones. So they sell this hardware. The iPhone sales have kind of been flat since 2022. But here's the best part about Apple is actually this services business right here. It's their highest margin business. Whenever you go spend like $100 in the App Store, Apple literally keeps 30% of that as a developer fee, basically developer royalty they get every single time. Like you go spend $100 on Clash of Clans, they keep $30 of that. And it's all like 100% margin for them. So this business is now over 109 billion of annual net income or annual revenue for them a year, and it's just going to continue to climb higher. Then they have, of course, the wearables, the Mac, the iPad. They were affected a lot by tariffs, but now Trump exempted Apple specifically from like a lot of these, and the tariff stuff hasn't really been hurting them. But here's why they were so affected by tariffs. I always thought this was higher, but only 36% of Apple's revenue comes from the US. Like it's way more outside the US. Like Europe is 26%, China 15. So yeah, and look at this net income. They're easily doing like 25 billion of net income a quarter if we kind of average it out here. And what is Apple doing with 25 billion net income a quarter? Since they're not spending money on AI, they're spending it on buybacks. They have the largest share buyback program of any company in the world. They do nearly 100 billion of buybacks a year, sometimes more. It just sounds nuts, but this is why Apple stock just never goes down. Plus, they have a dividend. They can raise their dividend a tremendous amount. So here's what the buybacks do. Net income's up 86, but net income per share is up by 90 because the share part of the ratio went down. They just buy back like 3 to 5. They bought back like 8% of the shares at $100. Like they are, it's so accretive to right now stock price. So anyway, Apple's a monster, never sell. I can say the same about Google. Like Google's the second biggest share buyback player. Um, let's see here. CorMedix. Yeah, let's do this one real quick. CorMedix right here. So CorMedix, this is a company I never recommend you should own with a meaningful amount of money, but they've had a great week. They're up 21% the past week. We're now green on them. We're up 7% all time on them. And this company is going to be so impressive to you and blow you away, and you'll want to buy them. But you do not want to touch this one, in my opinion, with anything significant. Like have it as a small position. But check out the market cap. I normally don't recommend these kind of companies. If you look in the top right, the market cap, they're worth $940 million. But the PE is a 5.4. They trade at 5 times net income, and they trade at 3.9 times next year's net income. You aren't going to believe these expectations. Look at the EPS. EPS is going to go from 30 cents to next quarter is going to be 84, 72. And look how much they beat this quarter. It was really impressive. And that's really from their Malenta acquisition. They remember how the company was worth $900 million? Well, they spent $300 million this quarter diversifying their portfolio into acquiring Malenta Therapeutics, because right now they sell only one product, Deaf and Cath. And this quarter specifically, I could not believe the quarter over quarter growth. Like if they didn't acquire Malenta, I still would buy this company, but they just diversified their and this is only one quarter. It'll be a bigger portion of their business, but that adds like 12 new products. But there's a big short thesis on them. Maybe the shorts are being squeezed right now. Check this out. 22% of all the shares are being shorted right now. But CorMedix is one that I'm going to hold. They print net income every quarter. I mean, remember, the whole company's worth 900 mil or whatever. They made 50 mil, 20 mil, 20 mil. They had, we're looking at operating profit because it says they made 108 mil of net income this quarter. They actually made only around 50 mil. But they have incredible, literally Reddit type margins. But when they went through, they're on their Deaf and Cath product. They're the only FDA approved cath. I don't want to get into it, but CorMedix is great. Is steak? Hey, I don't. That's some. I don't. I wouldn't. I don't know about that. That's no. What up, Renata? I see we're back. Hey, let's actually see how the market's doing real quickly. I'm not sure if you can see this stock, but it's called Hensoldt. The share price of 93. Hey, yeah, give me the ticker symbol, Mendo. I'll actually check it out. You know what? I'll type it in for you because I got you. HEN. Oh, I found it. You know what? We found it for you. Check it out, Mendo. So here it's an ADR. Sounds like some European company, a $9.9 billion company. Let's look at their numbers real quick. So we'll convert the currency from euros to USD just to get a little better idea. Looks like they sell sensors right now. That might be in demand from the whole AI crave. Let's see. Sales are great. Look at these top line growth rates. Revenue's up 18, 15, 20, so double digit growth. But when we go to the net income over here, it's a little choppy. Like they made net income this quarter, but last quarter they lost, but then made net income. But actually, the profits are heading in the right direction. Right? There's no, unfortunately, analyst covering this one. So okay, so here's where the revenue comes from. 60% Germany, 30% Europe. So there you go. Hey, what up, Robert? Yeah, we can look at Meta too. Yo, Nathan, I work for SO. No freaking way. Yo, that's actually a stock I just bought today. In no way someone's in here saying he works for the company. I work at Southern Company. I run the control room in the power plant. We're adding new power like crazy. Yo, they own so many great businesses like Georgia Power and Light, Alabama Power and Light. And they have so many subsidiaries. And I think the stock is, at a decent price. Their dividend's super safe. They have a 3.5% dividend. This is my newest position. I bought 11 shares of them today. So, Yeah, they're a regulated utility. I think they should just give you 7% of your money back a year on average from now on. Hopefully there. Yeah, I do need to get the charger. I just realized that. Oops. So actually, speaking of Meta right here, I do want to pull that up. Um, ooh, Oracle. We got TKO is such a cool name. Actually, they're getting a lot of licensing revenue. So let me go over Meta real quick. I do own Meta. It looks like they are down on the day. I wonder if there's something specific news here. EU ad compliance. Okay, whatever. But we are up 24% on them. We got 5 shares. Its current stock price is 654. I bought one not too at 644. Yeah, we barely get any dividends on this company, but you're not buying Meta for the dividend. You're buying them for the stock price appreciation and the future dividend. So let's check this out right here. Meta, this is a phenomenal never sell company. Forward PE of a 22 for a Mag 7 Meta. 22 forward PE is very fair in my opinion. Now, a few things are being questioned. Actually, I wasn't going to bring this up, but let's question this right here. Look at their daily active users. They have 3.54 billion daily active users, which is half the world. In China, which is like a quarter, they're not allowed to be on any Meta app. So this is really like 70% of the world. Hopefully that's not propped up on AI bots, but that's incredible. Here's why it's probably not propped up on AI bots. For the first time ever, they had a $50 billion revenue quarter. It went from literally the same time last year, which was a record Q3, it was 40 billion. Now it's 51 billion. Now, one of the reasons the stock did fall, if we go to their net income, it's just they only made 2.7 billion. So that crushed their EPS. EPS is just net income. So their EPS fell 82% as the net income fell 82%. But this was a one-time adjustment. That's why you always blend the net income with the operating profit. They had this one-time tax charge from the big, beautiful bill thing. But it was actually a record Q3, 20 bill of profit basically. But here's what's being questioned. If we go down to their cash from investing activities, again, you want this to be negative. If this is positive, that means they're actively selling off their assets for cash, but they're spending 20 to 25 billion of net income a quarter on chips, data centers, whatever, Scale AI, their what's that called? Metaverse. Actually, they just cut the metaverse spend. And whenever they announced that, the stock rocketed like 4%. Anyone remember that? Actually, it's kind of selling that off now. But anyway, I like the risk to reward on Meta. I am a shareholder, so I might be biased. TKO is a interesting name here. So, check this out. Oh, bonuses for stock performance on SO. That's pretty nice, Ben. So here's TKO. This is like there's no I guess competitor to this, or I don't know. So TKO. This is the perfect ticker symbol for this company. They own the UFC and the WWE. So that's pretty interesting. Yeah, look at this. WWE is 36% of the revenue. UFC is 30%, and then IMG worldwide. So I did not expect a company like this to do so well. But if we look at the forward PE, it's a 22. Of that implies if I was a shareholder of this company, would I be trimming or selling this stock? Absolutely not. I'd be diamond handing this one. Whoa, look at the revenue expectation in 2 quarters. So that maybe that's from some acquisition or I don't know. But yeah, it looks like EPS is going to go from 69 cents to $1.60. So I would just hold this one. Yeah, look at that. That's real net income they're making. So that's pretty cool. It's a niche stock. Okay. CoreWeave. You know what? Let's do CoreWeave. You know who actually owns CoreWeave? Hey, what up, Millers? Yeah, remind me to get to Rubrik. That's a cybersecurity play. I think they just reported earnings too. They had some good earnings. And OLP Papa, no way, homie. Thanks for the gift there. If you got a stock you want me to look at, let me know there, OLP Papa. I appreciate that right there. So here is the NVIDIA portfolio. NVIDIA is so big, they own part of CoreWeave, APLD, ARM, Nebius. Let's go over CoreWeave right now. Whenever NVIDIA does good, so should CoreWeave. Their recent earnings report was really incredible. So their contracted backlog doubled quarter over quarter to $55 billion. So they have $55 billion backlog of orders they haven't fulfilled. And that was fueled by large contracts with Meta, a $14 billion deal with Meta, and they expanded by $6.5 billion their deal with OpenAI. So, but their operating margins were below expectations, impacted by third-party delays. They actually lowered their guidance by $200 million because they couldn't get enough people to build the data centers for them. So that was being impacted. But here's what I love about CoreWeave specifically is the top line growth. Check this out. I think this is this should do good for the next couple of years, but I don't know about long term. But check out the revenue, the triple digit growth every quarter. It's 1.3 billion this quarter. Check out what's expected to be in 2 quarters, 2.3 billion. Like there's just so much growth expected at CoreWeave as companies like Meta and Microsoft and OpenAI don't want to, take on the liability of the data centers and the GPUs. So CoreWeave, Jim Cramer was doing this one about like Nebius and stuff. He short report. I think he's wrong, but in the long term, he might be right. Like this should do good for the next 2 years. And but yeah, there's nothing proprietary. It's basically a company that owns a bunch of GPUs in a data center, and these data centers and GPUs are in such demand from cloud computing demand. A lot of Bitcoin mining companies like Iris Energy, still like 80% of Iris Energy's revenue comes from Bitcoin mining, but they're converting into cloud hosting. Like they got a big deal with Microsoft, but they're buying these super pricey NVIDIA chips that will depreciate to zero in 15 years. And there's like this depreciation. Anyway, Corey's interesting though. I like them for like short term. What happens when the recession comes late and the AI bubble pops? Well, that means stocks are probably going to go down, and I'll be buying the dip. Uh, do we have any suggestions on penny shares? No. Hey, or oh, you mean companies that are worth $10 to $20? Hey, I don't ever. The share price is always irrelevant because you can buy fractional shares. For example, I did that today. I bought. You should never. Who cares? How psychological it feels. I bought 0.1 share of Ferrari today for $38. It's all just like buying yeah. Okay. What's this one right here? RZLT. Let's check this one out. RZLT. So Resolute. I have not heard of this company before, but they've done great for the past couple weeks here. What's the market cap? Okay, so a small one. Hey, we'll check out Adobe too. What up, Isha? Medtronic, that one's interesting. $960 million market cap. So they're still a $900 million company, and they're a revenue-less company. So when we go to the revenue right here, it says zero. It says no data because they've never sold anything. They've never sold a product or a service before, and they're losing a bit of money. Wow, they lost $75 million they reported fiscal year, but they lost $74 million, which is actually under 10% of the market cap. But okay, but they diluted you last quarter by basically 1/10 of the whole company, but it beefed up their balance sheet. That's how they can afford the net income losses. Anyway, maybe the stock is going up because they're about to maybe have some revenue soon. I don't know, but this isn't one I wouldn't want to own them just because they have no revenue. They're losing that income every quarter. They're diluting you. But as they probably sell something, the stock will do good. Maybe it's a super, super, super small position, but it's hard to trust anything meaningful in that kind of company. I do own some kind of those names though. There's always worth having those kind of stocks in your portfolio. Like I have some of those, like PSIX, Super Micro, Clear Secure. I think Clear Secure was up 12% today. So you start them as small positions, but you just allow them to grow into big size positions, and you don't trim them along the way. You don't trim them ever because they're such a small position to begin with. You never trim them. What apps do you use? Yeah, hey, all these apps these are all actually brokerages where you buy stocks on. They all send you tax forms and ask for a bunch of information. They're all in the link tree in my bio. My very favorite one is this one right here, the very first link in the link tree in my bio. It's called Moomoo. Free, cost nothing, no fees or anything. All of them are free, no commission. Okay. Marcus said, oh, wait, we're so behind. I'm so sorry if I'm missing some stocks. I want to get to FTAI as well. I'm so behind. What is TBBB? BBB Foods. Okay, so looks like they IPO'd 2 years ago. A $4 billion company. So they're actually we're going to convert the currency to USD. Looks like they're headquartered in Mexico. So let's see. Yeah, so 100% of the revenue does come from Mexico. But let's check out the growth. Wow, this is very impressive. Check out the top line growth. It's up 46%. Last quarter was 35. What about the profits? So looks like something just happened. The net income went negative. Let's see if it's acquisition related. Doesn't look like it. They are spending like 40 mil a quarter. So yeah, the operating profit really was negative. Look, let's assume that was a one-time adjustment. Like this company is normally making around 15 mil of net income a quarter. This is the before tax number. So, but that top line growth is very impressive. It looks like the margins aren't keeping up. I don't know. Let's see. I guess the analysts. Oh, like, analysts expected them to lose net income, but they lost more than expected. They're expected to stay net income negative for some time. Yeah, look at that, EPS negative. So, but it's not. There's barely any losses. Like, look at the EBITDA; they're losing like 10 mil, 1 mil next quarter. So, no. Anyway, I want to see them get profitable. Um. Okay. Ooh, TTW. Oh, this is an interesting name. Take Two. I like CoreWeave as a short-term play. Me too, spread the wealth. I think CoreWeave's going to do good. It's like a high beta Nvidia. If Nvidia's up like 1 or 2%, like they're up like 5 or something. So here's Take Two. This is the company that owns Rockstar Games. So if you've heard of GTA 5, Red Dead Redemption, this is the company that owns that. And they're in such a unique position, like where they have this asset, basically this game, GTA 6, they're about to release. It's supposed to be basically biggest game, top 5 biggest games of all time. Uh, whenever they release this game, it's literally going to bring them in billions and billions of revenue and just future streams of revenue for a term for the next 10 years. So they're basically right now the stock is pricing in that growth, and I think it's mostly priced in. It's tough to buy. Like the risk to reward buying it today is not great in my opinion, but whenever they released that game, and they actually delayed it. The release date is now going to be November 2026. So basically, call it a year from now if they don't delay it. And so they're a unique company. They should print net income whenever uh, they so here's actually, let's go over Netflix real quick. Are they up on the day? So Netflix is down again. Wow. So Netflix is starting to get super interesting. What's happening is Netflix announced to buy Warner Bros. Discovery for $82 billion without the linear networks. Well, freaking Paramount Skydance is announcing a $108 billion deal to buy this and the linear network, so offering a better deal than Netflix. And now if Netflix wants to compete again, they're going to have to bid more, and it's potentially, so that's less accretive for the shareholder to the EPS and stuff, and the stock is going down. Look at the forward PE though. Like this is the forward PE with all that nonsense aside. They're trading at 30 times forward net income. Like for Netflix, this is starting to get super attractive. Like this is this right around this price is where I start the nibble. I'd start a very small position in this one, maybe buy like half a share, 1 share today. And then once it falls another 5-10%, then you maybe buy with more meaningful amounts. Like the risk reward's starting to look is pretty attractive, but not to like, if you wanted Netflix as 5% of your portfolio, you don't make it 5% today, but maybe make it 1% or something, it's a business I love, subscription model. A lot of people like cancel their Netflix subscription way before a lot of other stuff. They make good net income every quarter, 2 to 3 billion of legit after-tax net income every quarter. It's insane, and the growth rates are very nice as well. And not just net income, but FCF, which is free cash flow, growth rates are nuts. So Netflix, it's a good business. TTWO definitely has GTA 6 priced in. Yeah, I think so too. BRX. Oh, this is Brixmore right here. I think, let me know if you're talking about this REIT right here. This is a grocery store focused REIT. One of my favorite REITs out there. They focus specifically on grocery stores, and their top tenants are literally, well, their top tenant is TJX, which their stock is literally like 20% of all their tenants is TJX. And look at TJX stock. So it's good to know that their underlying tenants are doing good. They own so many Publixes, or the triple net leases under them. They own so many Publixes, Kroger's, Ross. Actually, I think Ross is doing surprisingly good. Wait, where's Ross stores? Look at Ross freaking stores. Ross Dress for Less. That's also another one of their top tenants. I think they're third largest. They have. I've actually made a lot of YouTube videos about Brixmore in the past, and I used to own them in my Roth IRA. I would love to own them again. Oh yeah, check this out. I made a long time ago high dividend REITs to check out. Care Trust REIT, Realty Income, and Brixmore. Pretty cool. I really do like them. Let's check out RBRK. Sorry about that, Millers. Let's look at Rubric right here. This is a cybersecurity play doing acquisitions. Hey, Marcus, we'll do Grab as well. And I want to get to all these names here. And I remember to get to F1 as well. That's a FWONK is like, I was actually doing a deep dive on them earlier. So here's Rubric right here, cybersecurity play. The growth is just insane. And I'm a believer cybersecurity we're always going to need. As AI gets better, hackers will utilize AI. And I just think cybersecurity is always going to be needed. It's like AI proof version of software. Like you look at Adobe and Salesforce and some of these other software names, they're really getting hurt by it. And Duolingo kind of from this AI thesis. But look at Rubrik right here. The top line growth is phenomenal. Part of this is from an acquisition, but like this is great. The top line sales are up 48%, 50, 40, 40. Like it just hits a new record every year, every quarter. They are still losing a bit of money every quarter, but the losses have narrowed significantly. They lost 51% less money than the same time last year. If we go to their cash from investing activities, last quarter they bought a company for basically $800 million. So, and wow, look at the free cash flow up triple digits every single quarter. Like at this growth rate, like this is why I love this company is the growth. Massive growth, 80% gross margins, still negative net margins, but that's improving. Look at how they're beating the orange lines what the analysts expect. No wonder they gapped up on earnings day, specifically because the analysts expected 320, they did 350. EPS, they expected to lose 53, they only lost 32. And wow, look at the EBITDA or the EBIT. The EBIT was positive. This is the earnings before interest and their taxes. They were expected to lose 42 mil. They made 10 mil. Freaking good for them. Probably expensive though, like a really expensive one, but a company like that with those top line growth rates deserve a high premium for sure. What do you think about Grab? Hey, what up, Marcus? I actually really like Grab, actually. I like Uber more. If I had to buy Grab or Uber right now, well, Uber's like the safer pick, but check out Grab. If you're wondering what is Grab, what do? They literally do the exact same thing as Uber. Exact same thing, but internationally. If we go to where the revenue comes from, notice the US and Canada isn't on here. You know, their top country is Malaysia, which is 800 mil of revenue a year for them. Then Indonesia, Singapore, Philippines, Vietnam, all these other countries, which is so interesting. Like we know the commodity of ride sharing is universally needed. And here's what's so cool. They're net income positive every quarter now, which is great news, but they're backed by Uber. The very largest shareholder of this company is Uber. So Uber wants to see them do great. And this was also genius for Uber because it gave them instant international diversification because it would be hard to penetrate in those markets when Grab's already the leader there. So they just like, let's just buy Grab. And Toyota Motor likes them. 5.5% of the shares are owned by Toyota Motor. So I actually really like Grab. Growth that look at the revenue. It's supposed to go from 770 to 922. So and the EBITDA, wow, it's supposed to go from -5 to 100 mil in 2 quarters. And EPS is supposed to rocket up. So I actually do really like Grab. Forward PE on this one is a 65, so that's still expensive, but they just got profitable. So you probably want to do a multiple 2 or 3 out multiple. Rockstar never fails on new releases. Yeah, I'm not mad at Rockstar Games for releasing the GTA or delaying the GTA 6 release because they're perfecting the game. Like technology probably in the past like just 2 years have evolutionized so much where they can probably make the game so much better if they just wait another year. Like I can't wait to see what they're gonna do with GTA 6. Um, Hey, want to check out recent IPO of Chow? No way. I actually, we'll check them out. Ooh, Chipotle. I'm missing out. I forgot some other names I wanted to look at here. Hey, someone said Netflix. Hey, if you actually rewind the stream, like just like literally 10 minutes ago, you'll see my analysis on Netflix. I just did a deep dive on them. By the way, if you missed anything, best way to support me is just subscribe to my YouTube channel. I'm also streaming on there. So if you missed anything, you can like rewind it and stuff. So this is ticker symbol Chow. They are called Chow Chow Cloud International. They're a Hong Kong company. So we'll have to convert the currency. Oh, I think my thing just disconnected here. There we go. Okay, so we're going to convert the currency from Hong Kong to USD just to get a better idea here. So sale of software and information technology. Sale of hardware, sale of software. I like how I like the industry, but look at that. Most of the revenue comes from Hong Kong and Singapore. So basically, Chinese software company. Let's see. Oops. Chow Chow Cloud. For the full year 2024, and this is in USD. For the entire year 2024, they made 1.5 million in net income for the entire year. So that's not too much, but great that they're net income positive. So they actually have like a 5% net margin or 6% net margin for the year, 23 mil of revenue. So nothing's really blown me away here. They're really small. They're only worth 400 million. So think about that. That's a $400 million company that at least, making net income. It's Chinese though, so it's always going to trade at a low multiple. Price to sale. What's the price to sales right now? 17. That's expensive, but it's probably I'd be careful. Wouldn't own anything with a meaningful amount of money, but interesting IPO there. I actually haven't really looked at them. Can you look at LI Automotive? LI Automotive. I've actually never looked at this one. I've looked at like XBing Neo. Wow. I don't love this industry. All these XBing's probably the best one if I had to pick one. Because they're not losing that much. But here's LI Auto. There's such a like if this is just selling electric vehicles, like the end game isn't great. Like you're selling these vehicles for like a couple percent net margin. So yeah, there we go. Looks like the net income went negative this quarter. Was that real? That was real. They really lost a lot of money this quarter. Was that from an acquisition or something? No. So they actually sold assets, 1.1 bill of assets this quarter. So the revenue, this is not great. I can see why this stock kind of has not done so well. The revenue is down 37% and the net income went negative. But it was impressive to see them actually make net income all the quarters before today. That's actually surprising. Good for them. I mean, for fun, I guess we'll check out what their vehicles look like. But let's see here. BYD is really your China manufacturing play. Okay, there's their kind of cars. So yeah, Chinese, you know, I've seen a car that looks like that before. There you go. Okay. Let's see here. Do you know if you can check out a Danish insurance company? Well, hey, give me the ticker symbol. Maybe we will see if we can. We'll check it out. Parker Hannafin. I've heard of them. Yeah, hey, Tommy, give me the ticker symbol for that one. We'll check it out. Can you check out Bull? Hey, yeah, let's actually do Bull real quick. I think they're having a great day because Bitcoin's having a great day. I actually own no Bitcoin or any crypto, but my way to really still get exposure to it is through Webull, and Robinhood and FoodTube because it's like the picks and shovels play. Whenever you go do a crypto transaction. Oh, actually, wow, we're up 11% now on Webull. They've been they've had a great little month here. We were buying the dip on this one during the little Thanksgiving dip. We were buying it at 811, 830. So wait, we bought some at 770. That's crazy. So yeah, we were buying the dip on Webull. I never recommend you don't want to have this as a meaningful size position because to be honest with you, they are expensive right here. But it's definitely worth owning, just not as a significant size position yet. I'd love to see them go back to that $7.50 level to load the boat more because that's where I was building a lot of my position. But the forward PE is a 72. So they're trading at 72 times next year's net income, but I'm actually more bullish than the analysts are. And check out last quarter. Again, they just IPO'd, so we only have this one quarter here, but analysts expected 137. They did 156. Massive beat on revenue, massive beat on net income. And the reason I think they're going to do better than analysts expected because this is Webull right here. That stock we're looking at, ticker symbol Bull, is this brokerage, this app right here. I've been using their app for many, like 4 years now. And for the first time, they've just added in this crypto and prediction market stuff to the app. And whenever you go do stuff like that on the app, they get a big juicy commission. And that's what's actually made Robinhood go up so much is the prediction market and the crypto transaction fees are making them a lot of high margin, basically net income. And they have this like monthly thing. I don't pay for it, but that'll bring them some money too. All right. Yeah, I'm bullish on Webull. Heck yeah. Yo, UZ, yeah, Coremetics is having a great day. How's our Roth IRA looking on the day real quick? Our Roth IRA is up 1.7%. It's not done great year to date. It's actually, we've basically had our Roth IRA for basically exactly a year because the first 3 months of it was no money in here. But yeah, these are all our holdings in here. Here's our total equity in each stock. Wow, Bull is about to pass Innodata. Yeah, Coremetics is up 5% on the day. I think they're up like, 20% just a week. Pretty crazy. $500. What stock would that's a good question. I would just again, the goal of stocks isn't to get rich quick. It's to get 10% a year. I would just buy the S&P 500, fractional share. Because it's hard to outperform that. But then I'd maybe pick some individual names. Like I'd buy maybe a share of Google, Meta. I actually bought, and I'm always a fan of fractional shares. It doesn't matter. It's always, it's just the money you put into it is what matters. It doesn't matter if it's a point one share. Like today for Ferrari stock, I saw them on a nice dip. They're trading at a 33 forward PE. So I actually bought point one shares of Ferrari today for $38. So find some cool names you like. Netflix is Netflix. I really think Netflix is starting to look very attractive to start the nibble. Don't if you wanted five, don't buy 5 shares today, but buy 1 share maybe today or a fractional share. I think Netflix is starting to look attractive, and and when you own these companies, like whenever you own Google, you enjoy going on YouTube more. Whenever you own Amazon, you don't mind going on Twitch and Amazon Prime Fear, whatever. So anyway, and don't just buy a company because you've heard of them. Like I wouldn't buy Ford because I've heard of Ford before, but these companies have great numbers. Luffy says, I got 2 shares of Netflix. I started buying good stuff there. I legit might start my position right after this stream because Netflix is start the nibble. Nothing meaningful yet on Netflix, but start the nibble. Hey, Nick, good to see you, homie. He says DoorDash. Let's check this one out. And hey, we'll check out, Two Trick, good to see you, man. It's been a minute. We'll check out AppLovin, a phenomenal company. Then we'll also, Looney, we'll check out MBG. Well, we'll check out all these stocks here. And Nike, these are some cool ones. So here's DoorDash right here. They've had a nice little gap up since their gap down on earnings day. They've had a nice little recovery. They're still expensive, 4 times more expensive than Uber. Uber's actually at a 20 PE, forward PE, or maybe like a 22 actually. DoorDash is trading at 75 times next year's net income, but that's because DoorDash just went profitable. DoorDash just delivers you food. They don't do like ride sharing, I believe. But the cool thing about DoorDash is the day they announced this they did great. They had a partnership with McDonald's. And if you go on the McDonald's app, you can order food to your house through the McDonald's app. And it's all through the DoorDash network, but you never have to make a DoorDash account or go through any of the headache. You just do it on the McDonald's app and it's all through DoorDash, which is so cool, that partnership. But check out the net income growth rate. This is what's so cool. These are crazy growth rates, and this is real too. Record profitability quarter. The growth rates are nuts on their after-tax net income. Same with free cash flow. What's the FCF? 700 mil of free cash flow, netted 250 mil. And they actually acquired Deliveroo, which is an Australian, I think, anyway, if you go to the cash from investing activities, they spent last quarter basically $1 billion buying them. Great. That's even going to add more to the top line growth. What's this app? Yeah, hey, if you want to get this app, I'm on. What up, Sign? It's actually a brokerage. It's in the link tree in my bio, very first link there. It's an affiliate link, full disclosure. So if you go and deposit $100 or both, get some free stocks. So that helped me out. But yeah, it's just a brokerage. You can type it in on Google, broker called Moomoo. So let's do AppLovin. Then we'll get to Nike and some of these other names. I'm a little behind here. I do apologize. Hey, thanks. I'm doing great this Tuesday. Appreciate that, Nick. Good to see you. Roblox. Hey, Bailey, remind me to get to Roblox too. And Chipotle. Oh my gosh, I'm so behind here. Wow. AppLovin all-time high today, and they totally deserve it. They so deserve it. I've never seen a more impressive company in terms of financials. Like literally in 2024, not like a long time ago, 2024, wow, this was a $40 stock, a $50 stock. Now it's $700. Here's what justifies that. It's the same with when you look at NVIDIA. How did the stock 10x? It's because of their numbers. It always moves the stock in the long run. If another company can pull this off, then they deserve this as well. If we look at the revenue year over year, their sales increased 69% year over year. So the sales are up 69, but the net income is up by 92. But look at the revenue. The revenue was 1.4 and the net income was 835 million. So that means their net margin is a 60%. The net margin expansion here, I can't say in words how impressive this freaking is. It's so impressive. And, they made 835 million net income. That's after they paid, 250 million of taxes. The free cash flow was over $1 billion this quarter. Just insane profitability growth. Their ads are working so good that the SEC is investigating them right now for data collection practices. So they deserve this. 53 forward PE. And they always beat on expectations too. Great company. Deleveraging their balance sheet, look at the EPS. It's just straight up to the right. It's going to go from $1.60 to $3.13 in 2 quarters. It's going to be $3 a quarter. That's $12 of EPS. It's still expensive, but they deserve it. All right. Nike. Hey, someone said, show your portfolio. Yeah, here's this portfolio right here. I got multiple portfolios. Not sure which one you're talking about there, but this is called my buy, never sell portfolio. And sometimes if I a long time ago, one of the stocks I sold was Nike. I deemed it's not a stock I should own. So I actually sadly sold out of all my shares in Nike. I was dollar cost averaging into this one. I recommend if you like a stock, just don't spend all your money at once. Like on Netflix right now, if you want to buy them right now, don't just spend all your money at once. Slowly buy into them. Dollar cost average. It's a more disciplined, patient approach where you slowly buy it over a few weeks instead of all at once. But I actually completely sold out of Nike. I don't like their financials anymore. They're trading at 32 times PE, which is expensive. And if we look at the forward PE, they're trading at 33 times next year's net income. That's more expensive than that's more expensive than Google, Amazon. Actually, Amazon, did you know this? Amazon's coming for Lululemon there. Oh my gosh. We got to fill out a CAPTCHA. Thank you, TikTok. Okay, we're back. They made me fill out a CAPTCHA, but what was I saying? Yo, Amazon has a 13% market share for apparel and shoes and footwear, but the margins are being squeezed at Nike. So if we go to the revenue, the sales, the lifeblood of the company on Nike, this is the unfortunate. Well, this is why the stock has done so bad. It's not like it's not all priced in, but it's still expensive in my opinion. But for a commodity, they just sell shoes and stuff. But look at the revenue; it's up 1% year over year. That doesn't beat inflation. And last quarter, it was down 12, down 9, down 7, and so the sales were up by 1% year over year. Revenue is up by 1, but the net income fell by 30. And it really did. It fell by 23. And what does that mean? That means the margins are being squeezed. Look at the net margin declines year over year. This is unfortunate. And they pay a dividend. Actually, it's good that they made 720 mil this quarter, but last quarter they really only made, that was actually scary. They only netted 211 million. And so if we go, they pay a dividend. If we look at the cost of the dividend, they at least need to make 590 million net income. I actually don't like that the dividend payout ratio is so high. So the dividend costs 590 million and they made 720. So as long as they're making 700 mil a quarter, that would be better. They're in a rough situation right now. They are beating on expectations though, but it's a tough spot and they're not exactly cheap. In terms of valuation either. If anything, they're more expensive. And I'd rather sadly rather buy Amazon. I was actually just watching this whole CNBC video on how Amazon has taken over the whole market share for leggings and like huge market share, 13% for all clothes and shoes in the US now. It's the Amazon private label, Amazon basis brand and stuff, and they're great quality. Sorry, I kind of ranted on too long about them. AFJK. Hey. Let's check this one out. What brokerage should become number 4? I don't know. Probably, I have no clue. Looks like this company oh wow. So they're up 300% on the day. Even after their 300% rally, they're worth 218 million. So before today, this company was worth like $20 million. So obviously there was some sort of good news. It's not really anything we want to cover. It's just some momentum. Maybe you can tell me what that news is, but congrats if you own them before today. Looks like they got halted. Shares resumed trading. I wonder if there's some files for IPO or I don't know. But yeah, a very small company. How can you help an average person like me invest? Well, hey, I can't. By the way, watch out for people impersonating me. I'll never follow you, DM you. I sell absolutely nothing. I don't do any coaching or managing or anything. I sell nothing. Only way to learn from me is just watch the streams, watch my YouTube videos. But my best recommendation is buy the S&P 500 with the backbone of your portfolio because the average individual investor and hedge fund can outperform the S&P's 10%, 8 to 10% CAGR. And so you got to have that as the backbone of your portfolio. And then I play around with some individual names with your own strategy. Buy names you love, use, and can trust. Like here's some I picked: Google, McDonald's, United Rentals, Meta, CEG, Coca-Cola, Amphenol, Amazon, Ferrari. So these are just some of the names I like. I'm a little behind here. We got to get to some more of these stocks here. Oh yeah, well, I said Roblox earlier, so actually I'll kind of speed through Roblox here. You know who actually owns Roblox? Where's Kathy Wood? Actually, Kathy Wood has lost a lot of respect because her portfolios haven't been doing so well. Dang, where's Roblox? It used to be your legit third largest holding. It must have gone down so much. You know what? We can actually see all her different, she has a bunch of different ETFs right here, like the ARKQ, the robotics ETF. But let me just type in Roblox, RBLX. There's some great news and there's some terrible news. And the terrible news scares me from Roblox, but here's the good news. And I don't know if this is real. Check out this metric right here. This is their daily active users, not like monthly, but daily active users. Quarter over quarter went from 111 million to 150. I don't know if this is propped up on AI bots, but that is definitely crazy if that's real. But here's what scares me. If we go to their net income right here, they're losing 2 to 300 million of net income a quarter, and the losses aren't exactly narrowing. They're kind of getting worse. But check out the top line. Like the growth is good. Like the top line growth is good. Daily active users growth is good, but they're burning through 200 mil, 300 mil of net income a quarter, and they have a really leveraged balance sheet. So they were kind of like the original like metaverse play, 15 price to sales. They have the growth. I don't love how much net income they lose. It's because they're stock-based comp too. That's why the free cash flow, that's why you always got to look at all the metrics. You look at the cash from operating activities. You're like, wow, this is great growth, but this includes the debt interest payments that they have to pay, but this doesn't include non-cash expenses like, and it doesn't include the taxes and one-time adjustments either. That's why you always look at the operating profit and the net income, but their stock-based comp is really putting a number on their net income. Okay, I'm so behind. I'm so sorry. Oh, Tesla. Hey, remind me to get to that one in a minute. I sadly don't have anything good to say about Tesla from a financial fundamental point of view. Tesla's a momentum stock. It's completely out of the realm of any reasonable multiple right now. But here's Lockheed Martin. This is an aerospace and defense play. They've been flat for a while. They're the same price that they were in 2022 because the growth is really slowed. But I love how diversified that they are. Check this out, aeronautics, rotary mission systems, missiles, and space. But if we go to their top line growth here, revenue, actually the growth has come back. It's up 8% this quarter, which is great. Because if we look at the previous quarters, 0.1, 4, 1, 1, doesn't really beat inflation. But and the net income, the margins have been going down a little bit. But still, I like this name. They're not my favorite aerospace and defense name just because of their dividend. They have a high payout ratio. This one, it's a good aerospace and defense name, but I don't think it will outperform the other aerospace and defense names. This one's kind of like, it's a safe one. The government will never let this company go bankrupt. Certainly a safe one, but not my favorite aerospace and defense name. But they do massive buybacks. What app to buy stocks on for a beginner? Yeah, hey, I think this one I'm on right now because it has all the best analysis tools and every features. Yeah, basically, if you want to get this app or this brokerage I'm on right now to buy stocks, it's in the link tree in my bio, that very first link there. And if you're on the YouTube stream, it's actually in the link in the description. Yeah. What's up, John? Good to see you, man. John Lowe. Hey, so let's see here. Should we do? Maybe we shouldn't do Tesla. Marcus said, can we do I hope I can find this one. TRYG. We actually did find that one. TRYG. Okay, so they just IPO'd today. So actually, I don't think we can view this one because they literally just IPO'd today. They're a Danish company. I guess we do have some financials. It looks like they're making 200 mil of net income a quarter. But I don't know if that's the one you're talking about. My apologies there. That was a weird ticker symbol there, Marcus. But good to see you, man. Bitfarms. Okay, Bitfarms. So here's the thing with these Bitcoin mining companies, and I'm not just going to pick on this one. Like if you look at any of the Bitcoin mining companies, and actually Bitfarms specifically, this one's done better in the short term, this massive rally, because they're actually converting a lot of their, this company just owns a bunch of data centers and GPUs. They just own a bunch of GPUs and servers, and they're converting that from solely Bitcoin mining to a bit of cloud computing, because cloud hosting, and that's what Iris Energy is doing. So that's kind of the good news here. But historically, these Bitcoin mining companies just don't outperform actual Bitcoin, like Marathon. It's not just that Marathon, Clean Spark, Hut 8. They just I'd rather just own actual Bitcoin because all they're doing is just mining Bitcoin. So why not own what the gold is? Bitcoin is risky. And yeah, actually, I don't own any Bitcoin either. But I think Bitcoin's worth owning is like a small portion of of someone's portfolio. I actually own like the picks and shovels play of crypto via. I own Robinhood, SoFi, Futu, and Webull stock. And every time someone does a crypto transaction there, it just gives them a commission and then makes the stock go up. And by the way, someone just asked, yeah, the new stock I actually bought today was ticker symbol SO Southern Company. This one's a bit of a different one. It has a 3.5% dividend yield. It's a regulated utility. It should literally just return 7 to 8% a year. I don't expect anything more than that. Great dividend growth play that has a nice yield, but also keeps up with with stock price appreciation. Um, if you like aerospace and defense names, check out AVAV. Wait, AVAV. So, this one's on my watch list actually. Aero Environment. Forward PE is a 640, but looks like their net income loss right now. Maybe that was a one-time adjustment, or no? It says they lost 67 million. What's the top line growth? Wow. Okay, they must have just did an acquisition. Okay, so here's how you tell. We see the assets jumped up from 1.2 to 5. Let's go to their cash from investing activities, and makes perfect sense. The same quarter they bought a company for $1 billion. So that might be why the net income went negative, but it also made the sales go up or inorganically, but still growth nonetheless. Interesting. Can I keep 15%? Can I keep 15% of total portfolio? Oh, in Bitcoin? That maybe depends on your age, but huh. That wouldn't be crazy. Okay. Um There's so many stocks I haven't gone to. I'm so sorry here. So yeah, Zero said MUSA. So yeah, Murphy, this is a really boring company, but it's these boring companies I like. All this company does is own a bunch of gas stations, and like they're all next to usually Walmarts. But Murphy USA, uh, what are they called? Yeah, gas stations right here. That's all they do. And what's so cool, and this is the best part, it's I wanted exposure to oil and gas, but I didn't want one that I think is just going to underperform. I like MUSA specifically because of what they do. They pay a dividend, and the dividend is super low. I'll show you that right here. So, point being, here, look at this. So, if we go to the dividend, most oil stocks have a really high dividend yield and a high payout ratio. They kind of suffocate themselves with a high payout ratio. But this one only has a 0.5% dividend yield and only a 7% payout ratio. So, what are they doing with the rest of their money? Share buybacks. You won't believe this. You won't believe this. Look at the bottom left. These are the total common shares outstanding. 2025 Q3, there are 18.7 million shares. They've bought the same time last year there were 20.2 million. So they bought back 7.5% of the company. After they bought back 4.8% of the company. After they bought back 5.8. After they bought back 9.6 the previous year. After they bought back 7.72%. After they bought back 4.59. I mean, you can't make this up. The share count just goes down every freaking quarter. And look at the cost of the dividend. The dividend only cost 10 million of net income a quarter. So 10 mil in net income a quarter. Let's go see how much they netted. They netted 130 mil, 145 mil, like the dividend. And it's a 0.5%. It's literally like a free dividend. 10 mil in net income a quarter, super low payout ratio. Anyway, the share buybacks just help out the stock so much. So that's why I bought MUSA. It's, I think, a more growthier kind of oil and gas stock. No one really talks about them, and I don't have it as a major size position either yet. Maybe I will more. Oracle, okay, let's do Oracle. Let's check out this one. I don't love this one because the AWS beats, well, actually, AWS, Azure, and Google Cloud all have them outbeat in market share. So Oracle, it has like, I think, a 6% market share, but it's like a pure cloud play. You go to AWS or Amazon and Google Cloud, those stocks aren't obviously pure cloud plays. But if we go to Oracle right here, obviously this is in such demand. Like they're opening up like 30 new data centers. They had like a 300% like jump in the backlog. I think they're about to report earnings. I guess we can see what the analysts are saying. But when did they report earnings? Or I guess in a while. But their actual earnings this quarter weren't good. They missed on every metric, but they gave great guidance. So I don't love this one because they also issued a bunch of new debt. They have a lot of debt to pay. If we go to the net income right here, they're making, $3 billion of net income a quarter. And they also just issued a lot more debt. Let's go see what some news is. Weekly news. Oracle reports earnings. Wait, when did they report their earnings? I don't know. Yeah, so Oracle faces investor concerns over debt-financed AI expansion. So concerns over its $105 billion of debt used to fund AI products. So they have $105 billion of debt to pay. So, but they make $3 billion in net income a quarter. So they're making $3 billion net income a quarter. They have like 10 years of debt to pay. But the thing is, it's actually longer than that because they pay a dividend. And the dividend cost $1.4 billion of net income a quarter. So they're actually making way less than that. So I don't love this dividend. Like they have a nice 0.8% dividend, but they have a really high payout ratio. But I don't know. The forward PE is a 40. I mean, that's not nuts for Oracle. A 40 forward PE on Oracle. It's really not ridiculous. So, but I wish I had the metric of like their literally contracted backlog was up like 300%. Um, like just quarter over quarter. All right. So, um, can you do Upstart? Do you teach? How do you fund? No, I actually don't. I don't teach, but I actually have a YouTube video. Actually, he says, do you teach how you do fundamental analysis so quickly? I don't sell anything. The only thing I actually have a YouTube video do that. If you just go on my YouTube channel, look up Nathan Robert, look up how I analyze a stock. I have a video where I explain all my favorite metrics, and I'm only doing a quick glance if I'm doing a real analysis. Like we look at every metric and stuff, but we look at the important metrics at the top, or just at a quick glance here. So here's Upstart. They're actually at their IPO prices, the same prices they were in 2021. I think this company does vehicle loans and stuff like that. Or let me check out exactly. Or auto loans, I think. Upstart, provision of cloud-based artificial intelligence lending platform. Okay, so yeah. Uh, Personal loans with fixed rates. So yeah, car loans, I think is their main one. So some sort of lending business like this. Kind of maybe, let's see. So platform and referral fees. Check out that growth. This is actually great growth the past 4 quarters. 61, 100, 40, 40. So those year-over-year comps look great. They're beating on expectations. Or actually, they missed on revenue this quarter, but they beat on net income and they beat on EBITDA, so they grew their margins. Maybe, so that might have been a one-time adjustment, but if that's not, actually, it probably wasn't because their EBITDA grew. So that actually was real. The revenue grew 70% and they netted 31 mil on that. That's pretty nuts, actually. So they're finally profitable. They're investing a lot in the future. 120 mil this quarter. So I mean, everything here's heading in the right direction. 70% growth. But I don't love this industry though. I mean, I kind of own I own Dave. I'm at SoFi. I know does the same thing. What What's the forward PE on this one? Because they just went net income positive. Forward PE is a 45. Yeah, that's actually the same forward PE as a SoFi. Actually, SoFi might have a slightly lower forward PE, but interesting name there. Not that top line growth is super impressive. I will say that kind of justifies that multiple for sure. Uh, Wait, let's see. Any metal good stocks? Well, this is you're probably thinking of the precious metal plays. My favorite, like precious metal copper play, would be Amphenol, but it's kind of not a rare earth mineral stock. So let me remember to get to Apple. I'll get to them. Let me go to Costco. Then we'll get to HAL. What up, Sans? We'll get to HALO. And Palantir. Palantir's remind me. We'll get to Palantir after this too. So here's Costco. Yeah, so they've actually haven't had a great year. They're kind of just getting back to a normal PE ratio. They've always traded super like crazy expensive. Like they trade at 44 times forward net income. Even after the drop, they trade at 44 times next year's net income. But it's just such a great business, such a safe business model. Every month you pay for a subscription to get into the stores, and whether you go to the store or not, you still pay the subscription. And you love going there because you get a good deal when you buy stuff in bulk. Customers like going there. They got the lost leaders like the $1.50 Costco hot dog and the rotisserie chicken and stuff. So look at the net income they're netting easily it's positive year-over-year growth rate as well, which is great. Making basically $2 billion plus a net income every quarter, and you get a nice yield of 0.5% dividend yield. They sometimes do special dividends too. So Costco is a great, like, safe business model that probably is somewhat recession resilient as well. People maybe go to Costco more. Bring stuff in bulk. Let me get to Halo, then we'll get to Palantir. I'm so behind. I apologize. We'll try and get to Samsung too. And Mercedes. Hey, what up, Tree? Crazy Ethereum pump. Yeah, actually, there's the whole crypto market's pumping. Let me actually see. Yeah, look, there's Bitcoin right there, up 4.3% on the day. Wow, Cormetics keeps climbing. Weeble's up 4%. Let's go. Tesla's up. Is anything down on the day? Let's check out. SoFi's down off their debt offering. Uber's down. Hey, Uber starting to look really attractive at their like 22 forward PE. I bought 0.1 shares of Ferrari today. So yeah, let's check out this. What's actually down? AutoZone's down 7. Yo, this is the dip I've been waiting for. Let me re-add them back to the top of the watch list. I've been looking. That's actually concerning. There has to be news for AutoZone to be down 7%. Huh. Okay, sorry, let's get back to what we were doing here. Here's Halo, Halo. This is, wow, a big market cap. They're on my watch list too. So we analyzed this one in the past and something impressed me. Whoa, it must be this PE. So last year's PE was an 18, the trailing 12 months PE is a 13, and the forward PE is an 8. Wow, so they're trading at 8 times next year's net income. Let's go see those expectations. EPS, yeah, it's going to go from 93 to $1.50. Next quarter is supposed to be $1.70. So these projections are just up and to the right. This is so impressive. They're easily doing, and at this growth rate, what's it going to be the same time next year, you know? So that's incredible net income growth and just net income numbers. I can see why this one has done so well. And if I was a shareholder, I would absolutely not be trimming or selling out of this one for any sort of profit because 8.8 forward PE just implies to me that this one's going higher. Looks like they're in the biotech industry, but they have real sales and real net income. 68% comes from US, Switzerland. So they're international too. Not too shabby. Really nice numbers there. Oh my gosh, yeah, I forgot to get the Palantir. No way. Okay. Then we'll get to Samsung and AutoZone actually isn't expensive. Isn't their PE like a 23? Or isn't it? I think. What up, Zero? And wait, what was the other one I wanted to get to? SoFi, hey, what up, State? Maybe we can get to SoFi. Micron, hey, we'll get to Micron. Hey, Skills, we'll get to Micron too. So here's Palantir, a great company. Just the only thing that sucks is it's way too expensive, like a 8 peg or something, super expensive. 110 price to revenue, not PE, not price to net income, but the price to revenue is 110. But here's why they certainly deserve a high multiple. If we check out where did the revenue comes from, 55% of it comes from the government, and check out the government growth. This is insane. It's up 55% year over year. After grew 32, after grew 12, after grew 13. Like the growth rate is growing. It's just up and to the right. And not just on their government revenue, so many police stations use their software. Some people don't like them from ethics because ICE uses their software and like the military and the Air Force, but also commercial companies like S&P 500 companies, mom and pop shops, they also are in such demand right now for their data software. Look at this. Highest revenue ever on this segment. It's up 73% year over year. After grew 26, after grew 22. Like, they certainly deserve a high multiple. Beating on expectations every quarter with a freaking monster of a balance sheet. Absolutely no debt whatsoever. It grows their cash pile every quarter, earns interest on cash, prints net income every quarter. Everything I love about this stock, except the valuation. That's one I'd love to own. And I hate myself because I used to own them, but I sold them for not a huge profit, but I sold them for a profit, sadly. Sometimes the stupidest things and your biggest regrets will actually be selling out of great companies or trimming great companies like I did with Robinhood. I used to own like 55 more shares of this company. I sold it for a 3x profit, made sense at the time, but now we're up 9x and, or actually a 900% gain would be a 10x actually, right? Yeah, wow. Let's see here. W Weeble, I'm up 25%. Heck yeah, Millers. Yeah, I do like Weeble. I wouldn't have it as a crazy big position. Let's see. SSNLF. So, we can't find that one. Can we find like their ADR? Samsung? I can't find Samsung exactly. We tried. Wait. MBG, YY. Mercedes-Benz. Okay, we found their stock, Mercedes-Benz. They're like a luxury car. Well, what are their margins? Because this is probably makes me more bullish on Ferrari. So yeah, look at this, dude. I'd rather own Ferrari at their current price. So margins are being squeezed throughout this whole auto industry. It's just not, it's such a tough margin. But if we convert the currency from euros to USD, it's a European company. So yeah, let's see though. So the revenue is down. These are all negative year-over-year declines on the revenue. Maybe they're just, of course, seeing increased competition from like EVs or whatever. And, but they're still making net income every quarter, well over $1 billion to $2 billion of after-tax net income a quarter. But these declines are scary, down 27, down 65, and that's real. Whoa. So they actually, since they made $1.4 billion net income this quarter, they actually only made like 400 mil in net income. So that's a little funny money adjustment too. That's a little scary. So, but they're certainly a cool stock. Maybe that's why they're on a dip so much. I actually bought a fractional share. I never mind buying fractional shares, and of course, it dips more. But I bought zero point 0.1 shares of Ferrari today, and just in this how this environment is right now, you can't like if you wanted to race as like I do as a big size position, you don't make it a big size position today just with how the market is. So I'm just dollar cost averaging into this one. Ferrari brings to their bottom line a 21% net margin, which also they're being squeezed. Their net margin fell 5% year over year. But they make 400 to 500 mil. Mercedes-Benz makes way more net income, like 1 to 2 bill, but Ferrari has way higher margin. I think they're nearly the same size market cap too. So someone said, Joshua, I sold out of NVIDIA in 2007. We all remember those L's. Yeah, yo, actually, you want to see what Palantir, what's it today? Y'all are going to put L's in the chat for this. Wow, the market's actually pumping right now. Palantir right now at the top is $181 a share. Well, I sold it 9 shares at $8.29 a share. Like I was buying Tesla or not Tesla, Palantir in 2022, and I sold my shares at $8.29, and it's 180. We'd be up like nearly 2,000% on those shares. So that's I guess unfortunate. What app is this? Or hey, this app, by the way, all these are brokerages, software where you buy stocks on. They all ask for a bunch of information, syntax forms. They're all in the link tree in my bio. Robinhood's the second link in the link tree in my bio. This Moomoo's the first link in the link tree in my bio. They're all affiliate links too. So if you go and sign up, we'll actually both get like a little, if you sign up for Robinhood, we'll both get like a $5 free stocker. But anyway, yeah, the Qs, look at that. New intraday high on the Qs right as we speak. We're up 0.23%. That's great news. So yeah, sending up Google. Not too bad. We're at a new intraday high. No crypto's having a pretty nice day. We're all actually kind of patiently waiting for tomorrow's meeting. If you didn't know, super quickly, tomorrow we have the FOMC meeting, which basically tomorrow the Fed is going to announce the 25 basis point cut. And here's what the market is predicting right here. The market literally has for tomorrow, the FOMC meeting, 87% chance of a 25 basis point cut. So and a 12% chance of no change. And that's just based off the Fed dot plotted expectations. There's actually a lot of cool data we can see on here. But anyway, that's what we're waiting for tomorrow. And I'm actually surprised to see the market doing so well. In this portfolio, we're still down at this portfolio 0.4. Okay. Yeah, hey, all the apps are in the link tree in my bio. I'm not sure which one you're talking about. This one I'm on right now is the first link in the link tree in my bio, or these brokerages. Oh, dude, yeah, I do need to get the phone charger. We're on 7% here. Yo, the last few percent always hits different. It always lasts different though. All right. What AutoZone, bro? Okay, yeah, AutoZone was down bad. Here's the thing about AutoZone. Why I like AutoZone is one reason only. What's the multiple? So the forward PE is a 22. And it's down 7.5% of the day. AutoZone's the kind of company I want to own. It's recession resilient. Even in a recession, you're still getting your car fixed, your battery fixed, a leak, whatever. Look at their EPS a quarter, $50 well, it's a $3,000 stock, but here's the one reason I buy AutoZone. They don't pay a dividend, and because of that, they do massive share buybacks. Look at the shares in the most recent quarter. There's 16.6 million shares. Let's just go to 2019. There were 24, and that's 10% lower than the previous year. So dang, no way. There were 25 mil shares. Now there's basically 16 million shares. Anyway, they just buy back no matter what, 4 to 5% of the company every year. And because they buy, if they instead did a dividend instead of share buybacks, you'd get a 4 to 5% dividend. But because they spend it on share buybacks, the stock just never goes down. With their kind of slow growth, single digit growth, you normally never see a stock with that kind of financials have such a great stock price appreciation. There is some news though today. I don't know the news. Let me go check the intelligent comments here. Someone said, keep it coming. I haven't lost everything yet. But I wonder what the specific news is. Maybe it was Advanced Auto Parts. Advanced Auto Parts, which is like a competitor to them, is in the toilet right now. Look at their stock. O'Reilly's Auto Parts, though, is phenomenal. We're going to put AutoZone on the watch sheet. Okay. You missed. Oh, yeah, we already looked at TKO stock. We can look at them again, though, if you give me a minute here. Actually, let me look at this stock first, then we'll get to TKO again because their numbers were so phenomenal. TKO, that's the WWE, UFC. They're collecting so much licensing revenue right now. Here's the Cheesecake Factory. This actually, nothing's really blown me away here on Cheesecake, nothing's really blown me away here to really want to buy this stock. The Cheesecake Factory is literally the same price that it was in 2013. So you bought the stock over a decade ago. It's lower than it is, or same price that it is today, unfortunately. And that's because of the low growth. If we go to their main business, obviously the Cheesecake Factory, just check out the middle here. Very slow growth, 0.5, 0.9, 0.4, 1% growth, 3. So that does not beat inflation. And the whole restaurant industry, the food business is being squeezed. But good news for Cheesecake Factory, they are making a good net income every quarter. Easily 30 to 50 mil in net income a quarter. Actually, Wendy's is like doing the same. But like, look at Wendy's, for example. Obviously, they're not like the same kind of the same. But like Wendy's stock is at an pretty much all-time low. That's so sad. Way lower than their pandemic low. Not just Wendy's. Look at Jack in the Box, another kind of restaurant, fast food place that's same prices they were in 2004. Krispy Kreme, ticker symbol DNUT. This is pretty sad. All time, well, recovering now, but Krispy Kreme's only worth $700 million. They just can't make any money. They're losing that money every quarter. Only two things. Yeah, dead battery and my Wi-Fi. Looks like our Wi-Fi is doing good though. Is there somewhere where you can see your buy and never sell list? Or I don't really have, well, this portfolio right here, this is really my buy and never sell list, but I do have some watch list right here. Yeah, here's my safe never sell. I'm kind of still adding on to this, but here's some stocks that I think are great never sells. Waste Management, McDonald's, AbbVie, kind of AI proof. I have some hidden gem, I guess, watch list right here, where I have some stocks I really like and want to own. Some of these I already own, like ARM, for example. Did y'all know ARM is really a royalty company with like, look at this. We go to ARM right here. We go to their margins, legit 97% gross margins. I'm talking like just great numbers. And here's where the revenue streams come from. Look, they have 97% gross margins because 60% of the revenue is their royalty revenue streams, and then their licensing and other revenue. Like but the valuation's too nutty on ARM. It's way too nutty, but I'd love to own them. We've all probably heard of ARM before though. Okay, let's look at TKO right here. Here's kind of another like one no one's probably never heard of or didn't know they were public. This is TKO Group. They're at an all-time high today. And even though they're at an all-time high, they're trading at 22 times forward net income, which implies to me, if I was a shareholder and I was up a bunch, I would not even trim a single share. This is the kind of stock that's just going to continue to climb higher, in my opinion. It's a tough buy today, but because it's somewhat priced for, well, not even. I mean, we look at the EPS projections. If we go year over year, the EPS is going to go from 69 cents to $1.67. So the year over year growth rate, that's why the forward PE is going to go down so much. The revenue is going to go from 1.2 to 1.9 billion. They're already printing net income, a couple $100 million net income every quarter. After paying the taxes, they are printing money. And this is the company that, again, owns the WWE, they own the UFC, and IMG worldwide, and they license it out and just collect basically kind of royalty streams. What software you're using? Yeah, hey, what up, Nava? This is actually a brokerage. It's in the link tree in my bio, that very first link there if you want to get it. Broker called Moomoo. It's an affiliate link, full disclosure. So if you go and deposit $100, they'll both get free stocks too if anyone wants to get it. All these apps are on the link tree in my bio. They all ask for information and stuff. But yeah, actually, wow, new intraday high in here. Let me check the Roth IRA real quick. New intraday high right here as well on the Roth IRA. Let's go. The market is booming. Wow, Webull is up 5.5. What's our total percent change in every stock? So the only stock we're down on is Cavco, our newest position of Cav. This is our newest position in here. We bought the stock at all-time highs. Sometimes I legit don't mind buying. Like, it's kind of like TKO stock. Like, I wouldn't mind buying them at all-time highs, but not as a meaningful size position. I also think Netflix is a good stock. Ooh, Micron. Yeah, let's do Micron real quick. My fault there. Another stock. You're not going to believe this, and I've been saying this for the longest time. Micron's another one that's just going to, in my opinion, continue to climb higher. If I was a shareholder, you do not trim or sell any shares of this because the forward PE is a 15, and that's real as well. Check out the analyst expectations right here, and they always beat on expectations. They have for the past 3 quarters. Look at this. The EPS is straight line. It's going to be $3.65 next quarter, and then $4 $4 of EPS. Like, look at this. So net income is just EPS. So look at this. $3.2 billion in net income is the same for them as $2.80 of EPS, and it's going to go to $4. So the net income is going to be like $5 billion of net income. It's insane. Look at the top line growth. The sales are up 46, after grew 93. That's certainly worth a 15 forward PE. So net income's growing with that. Like, they made $3.2 billion net income, a record. That's after they paid $400 million of taxes. Like, that's real. This is a cloud memory business, wow, that growth rate. Look at that fiscal year over year comp, 200. So pretty cool. That's Micron for you. Just a really beast. Restaurants are a tough business, even the good ones. Yeah, that's why it's hard to justify going to Wendy's, Jack in the Box, when Chili's is the same price. Yeah, actually, my favorite restaurant play is actually not really a restaurant, but it's McDonald's. And they've actually brought the value back, like with the $5 meal deal and all that. But McDonald's, the corporation, this parent company, isn't a restaurant. They're actually a real estate and royalty company, because the franchises hold the bag, because the McDonald's parent company owns the land under 80% of the stores, and there's a 4% royalty they collect on so every time you go spend $100 at any McDonald's franchise, not the corporate owned, and they barely have any corporate owned stores. They're going to the franchise model because that's where the money's made. They let the franchises hold all the bag and the liabilities of the employees and stuff. Every time you go spend $100 at any McDonald's, $4 of that goes back to the parent company as legit a royalty. They call it a sales and marketing royalty, because all these franchises benefit. Like, whenever McDonald's does a commercial and all the advertising their big name, they benefit from that. Like the Grinch meal and the Minecraft meal deal. So they don't mind paying that 4% back to McDonald's. And some of the new franchises have a 5% royalty, and they own the land under 80% of the stores. So even in a recession, like, they still collect the rent and the royalties from every single store. And that's why in 2008, they didn't dip. This was in a recession. Historically, the sales at McDonald's go up, and they acquire a bunch of cheap land during the recession, when all the other restaurants, like right now, like Wendy's right now, all-time low. Or so that's why McDonald's is doing great, and Wendy's is at an all-time low. When you'd think like McDonald's and Wendy's at first glance would be doing good, but Wendy's is the one that owns a lot of their stores too. And anyway, I keep seeing big money piling at Palantir. Yo, what up, Jim? We actually just looked at Palantir. If you give me a minute, we'll look at them again. But if you rewind like 15 minutes, I think you'll find it. By the way, I'm also streaming on YouTube. If you miss anything, you can rewind it on the YouTube stream. That's the best way to support me. I barely get any viewers on YouTube. So if you want to support me, the best way is just watch the stream from YouTube. But I appreciate everyone on the TikTok stream too. Everything going up because of inflation. Hey, what's up, FC? Vital Farms. Hey, yeah, we can, Tuja. Give me the ticker symbol for Vital Farms and we'll check it out. Said monthly or lump sum for, I'm a fan of lump sum investing as well. And Travis said, take a look at CEG. Is it a good price? So CEG, unfortunately, does not look like a good price. And I really do need to get my charger. Oh, wow. Hold on. So CEG, this is your number one nuclear play of all time. There is no second place or close second place at all. Monopoly, this is the number one play, publicly traded stock for pure nuclear. They own legit 33% of all the US's nuclear reactors. There is no close second. That would be Vistra Energy, who owns like 3 reactors, but CEG owns like 30. And they're opening up this one with Microsoft, the 3 Mile Island one, the restarting one. So anyway, and they're acquiring Calpine. The value, this is so great because they do dividends, share buybacks, M&A, because they print money. But the valuation is expensive. But it's not really though because what they're about to do is they're acquiring this company called Calpine, and I kid you not, it's instantly accretive $2 of yearly EPS. So literally, you're not going to believe this. For the rest of time, every single quarter, it's just a net benefit of 50 cents to the EPS every quarter for the rest of time. So when that goes through, and that's going to close this quarter, it's saying the forward PE is a 29. I mean, and the current PE is a 41, but the 29 forward PE screams to me that if I was a shareholder, and I am, I would not be trimming, and I'm not. I got 15 shares. I'm up since it's tough for me to buy, but I'm up 75%. It's not the best risk to reward today. It's not a great buying price, but it's the best utility of all time. These GPUs forever. Also, as these GPUs get less efficient over time, they use more energy, but these GPUs from the AI demand still all got to get powered, and data centers and corporations want to use nuclear energy to market it. zero carbon emission targets, all that. Okay. We need a, hey, what up? So you look at the, see which stocks like Palantir. Hey, that's interesting. Ooh, let's see here. When's the last time a McDonald's franchise folded? I don't think I've ever seen one. That's a good point. I've like never seen a McDonald's shut down. You know, what's so weird is I go to this McDonald's every time, and right next to the McDonald's, there's an Arby's and a Burger King. And I kid you not, there's like a drive-through out the freaking McDonald's, like a long drive-through, and the Arby's and the Burger King are dead. There's no one there. I don't know why. Everyone just like, what's McDonald's anyway? That's just so like personal. Doesn't mean anything for the stock. Someone said APLD. What up, AJ? Let's do it. So APLD, this is actually they're owned by NVIDIA. Actually, check this out. If we go over here to the NVIDIA portfolio, and then we'll look at American Express too, and we'll Vital Farms. We go to the NVIDIA portfolio. Their largest holding is CoreWeave, and their second largest holding is APLD. CoreWeave, APLD, Nebius, they're all the exact same thing. At the end of the day, they just own a bunch of GPUs in a data center, nothing too proprietary. But they're in such demand right now. Like APLD is getting a bunch of contracts from CoreWeave and stuff like that. But yeah, check this out. So data center hosting is now 60% of the revenue, and basically hosting is all the revenue. High performance compute hosting business. So they beat good on expectations this quarter. Analysts expected 45 mil. They did 64 mil. That's quite the revenue beat. And the EPS, they were expected to lose 13 cents. They only lost 7. I guess they lost more in EBITDA. So maybe that EPS was like a one-time adjustment, funny money thing. Oh, okay. Or I don't know. But anyway, this should just be like a high beta NVIDIA. In the long run, they might be the bag holders. But the momentum is great on this one. Like there is no like forward PE because they're expected to lose money for time. But anyway, NVIDIA has been hiccuping because NVIDIA is basically giving money to CoreWeave, APLD, Nebius. They're taking stakes and giving them money just for CoreWeave, APLD, and Nebius to go buy NVIDIA chips with all that money. So there's like this circular thing that's happening right now. Like NVIDIA owns $100 billion of OpenAI. OpenAI owns 10% of AMD. So whenever AMD goes up, NVIDIA goes up, and the orders, and it's a whole. But we're good for through the end of the decade, I think. That doesn't matter. The Ponzi scheme will not end anytime soon, and we're chilling. Well, that's my opinion. VITO. But hey, none of this is financial advice. I'm definitely not an expert. Don't listen to me. I saw nothing. Please watch out for people impersonating me. I have no course book, no coaching, literally nothing like that. Literally saw nothing. So want to support me though, hit the follow button. We stream every single day. So here's Vital Farms. They're a $1.4 billion company and the forward PE is a 19. That's actually great. The current PE is a 25. The forward PE is a 19. Vital Farms, maybe that's a fair multiple for maybe eggs and egg-related products. So a commodity like eggs. You know, I've actually... If you know me, I've been buying the dip on Calmain. But let's actually go see the difference. They're actually roughly the same. No, this one's a fourth of the market cap, but they're a $1.4 billion company. That's actually a way higher forward multiple than Calmain. But they also have a great balance sheet. Looks like 145 mil of cash. Well, actually not a great balance sheet. Long-term debt. Okay, so it looks like no debt really, except some capital lease obligations. But, you know, honestly, this one looks, well, 16 mil of net income a quarter. I mean, 20 forward PE. If I wanted a chicken egg stock, this one appears to be good. I think I like Calmain more though. What's the dividend on this one? Do they pay a dividend? No, so no dividend on this one. You know, actually, Calmain is they have a higher market share than Vital Farms does. CALM, we're actually now up 5% on them. And 10% dividend yield, 8 forward PE on this one, 8.6 forward PE. And look at the market cap on this one, $4.2 billion of cash. And you're not going to believe this. This company literally has, $1.25 billion of cash on hand with no debt whatsoever. So literally 25% of this company's market cap is just their cash on hand. And look at this net income, printing a couple $100 million net income every quarter. Also kind of like Vital Farms, but Vital Farms only makes like 17 mil. They make a couple $100 million. So I think Calm's the way more bigger beneficiary. It's cheaper. It's bigger. It might just be safer. And probably don't repeat what I just said there, but. Let's see. Oh, American Express. I forgot to get to that. Oh, and JP Morgan, dude. Yeah, hey, no problem, UZG. JP Morgan has been a sleepy monster. I mean, a boring bank, JP Morgan, it's not only had this monster stock price appreciation crushing the S&P 500, but along the way, this chart doesn't even include the 1.8% dividend you get. They raised their dividend. Yeah, normally they have like a 2 to 3% dividend, but the stock has gone up so much that it makes the yield go down. But even if you buy the stock right now, you still get a 2% dividend, which is phenomenal. JP Morgan's great. Never sell. But you won't believe the net income they print. Look at this. We go to net income right here. They make this is after tax net income a quarter, 14 to 15 bill a net income a quarter. Not many other companies like it. What type of penny stock is good? Yeah, hey, I don't know if I would I don't really like those kind of stocks, like low market cap. I see you like Murphy. What about Valero? Hey Ben, give me the ticker symbol for Valero. Is that like another gas station play? I like Murphy USA the most because of the buybacks they do. It's insane. Where was another stock I wanted to get to? Oh yeah, American Express. American Express. That one is actually owned. And then we'll get to, someone said I'm down 50% on Novo Nordisk. Am I cooked? Sadly, probably. We'll check out Novo Nordisk after this because they honestly, Novo Nordisk might, according to my math, be fair valued, if not even slightly overvalued at current prices on my fair. Anyway, we'll talk about Novo Nordisk after this. We're talking about American Express here. Yeah, you know who owns American Express? Is the homie, the legend, Warren Buffett. He actually just bought, this is so surprising, his only new position this quarter was Google. He bought Google. What did he sell out of? D.R. Horton. But his second largest holding, is Apple, and then the second largest holding is American Express. It looks like a JP Morgan. The stock prices almost look identical. Actually, this one's probably doing a little better than JP Morgan. And not only crazy stock price appreciation, but the yield's always been over 1%, but a 0.6% dividend yield. They raise the dividend every year, way faster than inflation. What's the multiple? A 24 forward PE, or that's a 24 PE and a 22 forward PE. That I would not be trimming or selling out of American Express at these prices. I mean, that's insane. And they're netting 2.5 to 3 billion of after-tax net income a quarter. Let's go see how much their dividend costs. They made 2.9 billion of net income this quarter, and the dividend cost that's their stock buybacks. Wow. Whoa. The dividend only cost 580 million. The dividend costs 580 million. Since they have so much leftover money, they spend 1 to 3 billion of their net income a quarter on share buybacks. So here's what that does for you. No wonder this stock's at all-time highs. The net income's up by 15, but the net income per share is up by 18.6 because the share part of the ratio went down so much. They're a beast. All right, Elf stock. That one, unfortunately, a lot of these beauty stocks have been struggling. Elf just went through an acquisition. Well, I'll show you that. Oh, I've wanted to get to Novo Nordisk. Remind me for Novo Nordisk, but so this has always been an expensive company. They traded a high multiple, and it's okay to trade at a high multiple as long as you beat your growth expectations. But this quarter, the analysts expected 365 mil of revenue. They only reported 343. Analysts expected 38 cents of EPS. They only did 5 cents. So that might explain why they had such a massive gap down on actual earnings day, because they missed on growth. And but part of that was acquisition related. Their EPS, their net income, was like, if we go to their net income, it says they only made 3 million of net income this quarter. Well, if we go to their cash from investing activities, they bought a company for $600 million. So I'm actually curious about that. So that's why their balance sheet went from, 1.3 bill of assets to 2.3. They bought that company. Did they raise money to do that? So yeah, they had, that it looks perfect. They spent 600 mil buying a company. They financed 600 mil of revenue for it, or 600 mil of debt. So, or they issued stock. I don't know. Maybe that could be, it's either one or the other. They issued stock or debt. So the forward PE of a 50 is expensive, 50 forward PE, which implies that this kind of big, massive gap down might be justified. And it might even still be a slight bit pricey even here. But again, if we go to, they missed on their growth expectation, but what is the growth? The revenue's up 14, but it's up 14%. That's after that acquisition. So yeah, we want to see the growth kind of come back. We know the consumer is kind of hurt right now, like, even Target and their beauty product sales are down bad, but, it's not just them, look at, like, East State Lauder, these are very similar competitor, East State Lauder, Elf Beauty. Look at East State Lauder. Same prices they were in 2017. Maybe that's it. I don't know. Hopefully that was helpful there. Probably. I was kind of not too positive on that. Um, Core Medic's popping. Yeah, man. Actually, let me go check that out real quick. We'll look at a few more stocks here. Uh, let's see. Yeah, we own them in our Roth IRA. They're up 5.8%. That's crazy. Weeble's having a great day as well. They're up 5% on the day. We've been kind of talking up that one for a while too. Okay. Vicky said Nike. I don't know about Nike, but let's do Novo Nordisk. So this is actually your weight loss company. This is the stock that owns Ozempic and Wegovy. Elon Musk is on Ozempic, and so if we go to where the revenue comes from, 93% of it is their diabetes and obesity care products. But here's the bad news. They're trading at 12 or basically 13 times PE. The industry average is a 23. Why are they so below the industry average? Is because they actually lose their exclusivity for Ozempic in about 2 years, which is probably being priced in and it's going to be a generic kind of commodity at that point. They're also seeing increased competition already from Zepbound. They tried to acquire Metsera for $10 billion, another weight loss prescription, but Pfizer outbid them and acquired them. Why was Novo Nordisk trying to acquire them? Because their patent expires. And so sadly, this 13 PE might be justified, as well as missing on their growth. Like if we could look at this quarter's expectations, analysts expected 12.1 billion. They only did 11.7. That's kind of a massive miss. Their margins got hurt bad. So the sales were up 10% year over year, but the net income fell by 22. So revenue's up 10, but profits are down by 22. And that really was. Operating profit was down by 26. What does that mean? That means margins are getting crushed. Their net margin went from 38% to 26. So it's also another reason from that. Ozempic got added into Medicare and Medicaid. You can buy Ozempic through Medicare and Medicaid, but they cut the prices like by over 50%. So of course their margins are going to go down if that's the case. The sales will go up and the margins will go down. That's the exact recipe of that. So it might sadly be fairly valued or justified at this 13 PE, which is sad to say. If you had to pick five stocks to ride out any storm, what would you pick? I would pick ABBV. I'd pick Waste Management. Like, even though these are boring companies, they still do good. I mean, look at Waste Management stock. I mean, they've done great. Waste Management, McDonald's, AbbVie as well. AbbVie has a good dividend. A lot of these have good dividends too. So yeah, those are some good picks. The safe picks, I should say. Let's see here. Netflix. Hey, we can look at Netflix again. We looked at DoorDash, and maybe we can look at DoorDash again. We'll look at a few more stocks here. No, we've been streaming for 2 hours. I hope y'all, if you guys wanted to follow button, we actually stream every day. We just look at stocks and stuff. I sell nothing. So here's Netflix right here. The forward PE is a 31. That doesn't include all the Warner Bros. Discovery stuff, because Netflix announced to buy Warner Bros. For $83 billion, but unfortunately, they just got outbid by Paramount Skydance for a $108 billion offer. So Netflix will have to raise their bid, and that's going to be less accretive to or basically more decretive to their EPS and stuff. But that'd be so cool to see, like the Harry Potter stuff and all on Netflix. But we can see right here, they have 300 million premium subscribers. They did the thing where they have this ad-supported tier and their normal tier. So, and it's actually growing their ARPU. Their average revenue per month per user is $11.69. If you go to their net income, they're printing money. Subscription model company. A lot of people cancel their Netflix like last out of all their subscriptions. They're making $2 to $3 billion of after-tax net income a quarter. I mean, pretty great net income numbers. Same with free cash flow. That's what FCF stands for. So they have so much leftover money to just invest in the future, do buybacks, buy Warner Bros. Discovery, do acquisitions. It's tough to do acquisitions for Netflix. They'll probably even pay a dividend in like 5 years or something. But Netflix can afford to buy them. But I don't know what I was going to say there. Yeah. Anyway, Netflix, I think honestly at this price right here, it's worth a nibble. Like it's worth buying a super small amount. The risk to reward is actually looking really good, pretty good at this price right here. All right. So can you find out why AutoZone dipped? I think it might just be because of American Auto Parts. I don't know if there was anything specific here because, I feel like the news would have been all over this. Oh, wait. AutoZone dips after Q1 results. O'Reilly Automotive shares are trading lower so AutoZone did report earnings. AutoZone's weaker than expected Q1. So AutoZone reported earnings today. I must have just missed that. Okay. Um, I am curious to see, did 31 of EPS? AutoZone opened 39 new stores in the US. So yeah, okay, 31 of EPS, 3104. So there we go. That's what they reported. So here's the quarter. Let's see what they did. So they slight missed on revenue, a slight miss on EPS, and a slight miss on EBIT. So it really was a slight triple miss quarter. But I mean, forward PE 22, their EPS will just keep getting helped out by the share buyback. So actually, I like AutoZone. They're recession resilient. I'd love to buy them even on a more dip. So I'll be watching them on my watch list. It's a stock I'd love to own. It's a company that just rewards you via share buybacks. And, even in a recession, people still got to get their car fixed. And actually, people, instead of buying new cars in a recession, they spend more fixing up their old cars. So there's actually a lot of, okay, FWONA. There's like two different ticker symbols here. FWONK. Wait, FWON. Let me see if I can find this one. So yeah, Liberty One Formula. I was actually reading this. Their average Formula One team, like there's all the Formula One teams like Ferrari, have increased like literally 6x since COVID. Like the average F1 racing team. There's a lot of interesting stuff around this name, but a super expensive company. The forward PE is a 68. 68 forward PE. Let's see if there's any kind of AI results or any AI news. Nope. Well, let's see. Let's look at their actual numbers. So yeah, Formula One, that's 80% of the revenue. Let's kind of look at that on an annual basis. Yeah, look, highest 2024, the full year 2024, record year, well above 2019. Moto GP. Let's check out the bottom line down here. So looks like it is a little bit choppy right now. But Q2 was amazing. Yeah, so they really did lose money in 2025 Q1. Did they? Oh, wow. So hold on a second, though. Look at this quarter. They spent $3 billion buying a company. I don't know what they bought this quarter, but you just go to their cash from investing activities. You want this to be negative. If this is negative, that means they're buying an asset. If it was positive, they're selling off their assets. They bought something for $3 billion. That's also why their balance sheet went like that. Maybe that one-time adjust to their EPS as well. Anyway, this is a super niche company. I was looking more into them. Forward PE is 68. Isn't nuts. I guess I bought a little bit of Ferrari today. I never mind buying fractional shares. I actually bought 0.1 shares of Ferrari. Obviously, it's just been straight down since. But in this environment, you want to be slow to make something like a meaningful size position. CrowdStrike, CRWD. Hey, yeah, this will be like the last one we look at here. You know who actually owns CrowdStrike? Would be the homie, the genius Nancy Pelosi. She's a super investor. Her net worth's over 100 million in Congress, so she has to make all her trades public by SEC law, so we can see what she owns and her exact weightings. And one of the stocks she owns is CrowdStrike. It's a cybersecurity play, probably the best, if not the second best cybersecurity company in the world, the whole world. Behind like Palo Alto Networks. Like this is the best cybersecurity play. Over half the S&P 500 use them, but if we go to their net income right here, they're losing a lot of net income. They used to be making net income. Why'd it go negative? So back here, CrowdStrike had this update, and it literally bricked every Windows computer when it did the update. So literally, if anyone remembers that day, I made a short about it. I know TikTok, like if you go scroll back a year ago, but it literally made every single plane in the US have to land. Like it caused so much outage and disruptions. This was in July 16th, 2024. So, and then the CrowdStrike CEO came on the interview and started coughing and couldn't stop coughing. I kid you not. It was the most awkward thing. It was while being interviewed about this. he could not stop coughing for like 5 minutes. It was so embarrassing on that day of all days. But CrowdStrike is the best cybersecurity play. They're almost like immune to the whole AI crush thesis right now. Or like you look at Salesforce and Adobe and Duolingo and some of these other software names are really getting hurt by AI, like commoditized and all that. So, but CrowdStrike in cybersecurity, the industry, I think is immune to that because hackers will utilize AI. It's always going to be in demand. I love the top line growth. Like they're a subscription model company. The top line growth is just insane on CrowdStrike. So, let me pull up what the annual revenue right here. Like, look at that. Every year, like in 2017, look at this. In 2017, for the full year, the revenue was 50 mil. It went to 118, then 250, and every year since then. Anyway, CrowdStrike's a beast. We do want to see them get back to profitability, but they can afford these net income losses. Their free cash flow is insane too. So yeah, that was the stream. I hope you guys have a great rest of your day. I'm actually going to give a quick portfolio update and then I'll get out of here. If you wanted to follow button, we stream every day. We'll be streaming tomorrow at the same time. So here is our dividend portfolio. This is our Robinhood account. It's called dividend only at the top left because every stock in here pays a dividend. Oh yeah, here's us year to date. We're up 16% year to date. When we earlier this year, we were down like 14% during the tariff shenanigans. So yeah. Year's almost over, which is crazy. Here's all the stocks that we own in here, and here is our total percent change on every stock. Luckily, we are green on every stock, except for Carlisle, a little down on that one. We also have a Roth IRA. Roth IRA is just a tax-free retirement account. We have a lot of, I try to make this more growth-oriented while still having some safety names in there. So yeah, and then we have our Moomoo portfolio. This is known as our buy and never sell portfolio. The reason, look at this year to date, the reason we're up 84% on a return money weighted average. So every time I deposit money, it makes this return go down more and more. So this is a great metric. We're up 84%. We were doing just as bad. Look at this during the April dip. We were down just as bad, 16% year to date, but now we're up 84. How? Well, you can think, just one of the reasons, comfort systems. We bought the dip and we haven't trimmed. That's the reason we haven't trimmed or sold any of our position since then. And I wouldn't, and I'm not planning on to. The 33 forward PE on this company, S&P 500 inclusion, this is the kind of stock that's just probably going to continue to higher. We bought that one during the April dip, but not just them, Amphenol as well. We bought most of our position during the dip and we've still been buying a little bit more ever since. Amazon as well. We just took advantage of the dip. We didn't panic sell. We just bought and we haven't trimmed since because some of your biggest regrets and my biggest regrets are actually selling and trimming out of great companies like Robinhood. I used in Palantir. I sold most of my position for a 3x, and now we're up 10x on the position. So yeah, we of course have some losers. This is our Webull portfolio. It's like our risk on account, our open profit and loss. We definitely have underperformed in the long run, but we're up 21% all time in here. And these are all the stocks that we own in here. AMD, Futu, UiPath. We did trim UiPath. We have exactly 100 shares now. We sold a bunch of UiPath or trimmed it to buy Southern Company today. Our newest position, if you're looking for a somewhat higher yielding name that I think will still have good growth, is Southern Company. Ticker symbol SO. You get a 3.5% dividend, and I think still good stock price appreciation. Oh, and Progressive came in clutch today with a $13 special dividend today. So that was kind of crazy to see. But yeah, anyway, if you want to support me, the only way to support me, best way to support me is subscribe to my YouTube channel. I'm also streaming on there, and you can like rewind it. I'm trying to build up my YouTube channel. So yeah, just subscribe to my YouTube channel. It's called Nathan Roberts. Also in the link tree in my bio. You can just type in YouTube Nathan Robert. You'll find it. Have a great rest of your day. We'll be live tomorrow at the same time. We stream every day. So see you all very soon. I appreciate all y'all. Thanks so much. And thank you to everyone on the YouTube stream the most. Y'all are the real ones. Yo, Steven, Looney, see you guys later.